Hey guys, what's up? I'm Erin and welcome back to the channel. Americans are no strangers to debt. The biggest categories of debt are housing, with about $11.85 trillion in outstanding mortgage debt, student loans with a total of about $1.76 in debt, auto debt, roughly $1.5 trillion, credit card debt coming in at a whopping $1 trillion, and finally, personal debt of about $300 billion. And managing your debt levels is critically important to maintaining financial health and stability. But right now, there's a question as to how affordable all this debt really is. Because recently, we've seen debts in each of these categories grow to record levels. On the personal finance front, I feel like more often than not, we say most debt types are not good. I feel like most people in the personal finance space agree on this. The one sticking point tends to be around mortgages and questioning whether this is a good type of debt or a debt that you should pay off really quickly. Buying a home allows you to buy an asset that will likely appreciate over time, and in a way, it can act as a forced savings account as you build up equity in this home. On the other hand, you have a group of people who say, doesn't matter the debt type, just pay it off, become debt-free, you'll feel much better. And I think it really comes down to personal preference here. From a societal front, the narrative is really different. We live in a society that promotes a lifestyle of consumption and not really is just accepting, but encouraging of debt. Can't afford those items you want today? No worries, just put it on a credit card, or at least that's what society says. Or you can take advantage of a buy now, pay later service. So instead of having to pay $50 today, you can spread that out over 4 weekly installments. Maybe that car is a little bit out of reach. No worries, they have a fix for that as well. Now you can take a loan that goes for 7 years or longer. And while this debt stretches individuals thin on a personal level, there's no denying the fact that from a societal standpoint, there are rewards for individuals taking on debt. Consumer spending helps to drive economic growth, and spending more than people currently have, meaning that they take out loans to fund their spending, that stimulates the economy even more, increasing the demand for goods and services, leading to higher production, leading to job creation, leading to economic growth. By being able to buy a home with a small percentage down and financing the rest, individuals can use it as a wealth-building tool. Over time, homeowners pay down their mortgage and property values appreciate and they build up equity in this home. And over time, for most homeowners, their home ends up being a significant portion of their net worth. And investing in housing, this definitely boosts our nation's GDP. Recession risk. Now, this is a fine line that we walk because if individuals take on too much debt, these high levels of debt can make our economy more vulnerable to economic downturns. If consumers are heavily indebted and then the economy falls on hard times, they may be forced to drastically cut their spending, and that can worsen an economic downturn, something we saw back in 2008. One of the biggest problems with using debt to fund a lifestyle is that it results in significant interest payments. Borrowing money from someone else to pay for today inevitably makes everything you buy more expensive. And if everything comes with a higher price tag, that reduces your disposable income, and that reduces your ability to save and invest for your future. That makes it harder for you to put yourself in a better financial position. And especially in today's high interest rate environment, this is definitely something to consider. Looking at the past 15 years, we are facing interest rates that are the highest we've seen in recent history. And all this means that all of this debt is now more expensive. One of the biggest things you can do to help reduce your debt burden is to make sure that you qualify for the best interest rates you can. Presently, the Federal Reserve has yet to announce any rate cuts, so we're likely to see these higher rates for the foreseeable future. Once inflationary pressures get under control, the Fed will start to make rate cuts, but it's likely to assume that this will be a lengthy process. Housing is a difficult one right now because we have stubbornly high housing prices coupled with stubbornly high interest rates. But the good news is that 60% of all current mortgage holders have a mortgage rate that is 4% or less. The bad news is if you're shopping for a home today, you're not likely to get a mortgage rate like this. The rate you face is going to be higher, but there are things you can do to make sure you qualify for the best rate possible. First and foremost, address your credit score. Getting a credit score of at least 780 puts you in a good position to qualify for the most favorable loan terms, meaning the lowest mortgage rates. The best way to boost your credit score is to simply pay your bills off in full and on time every single month, and make sure you're keeping your debt utilization lower. Then just repeat this process for a very long period of time. You can easily get an all-star credit score simply by using a credit card responsibly. Increasing your down payment can also give you more favorable terms on your loan. and this has to do with your loan-to-value ratio. The loan-to-value ratio compares the value of the property compared to your loan amount. A higher down payment gives you a lower LTV ratio, which is seen as less risky, and that can help you qualify for better interest rates. For instance, an LTV of 80%, meaning a 20% down payment, is generally seen as more favorable than an LTV of 90%, meaning a 10% down payment. Most conventional loan lenders offer tiered interest rates based on LTV ratios. A larger down payment can place borrowers in a lower tier, qualifying them for lower rates. Also, if you go the route of a conventional mortgage, ensuring that you have this 20% down can help you avoid additional costs like PMI. Lenders also prefer borrowers that have a lower debt-to-income ratio. This ratio looks at your current outstanding debts compared to your income. Conventional wisdom, or the big financial institutions, will tend to say that having a debt-to-income ratio of 43% or less is considered sufficient. But good personal practice is to have a ratio that's even lower. I like to think that less debt is better. The less money you owe to other people, the more breathing room you have in your budget. So if you're looking to take out a mortgage, now might be a good time to pay off any other outstanding debts. You could also opt for a shorter loan term length, looking at, say, a 15-year loan versus a 30-year loan. Interest rates will tend to be more favorable on a 15-year loan, but keep in mind that if you take a shorter term length on your loan, it's going to come with a heftier monthly payment. But in the long term, it'll save you a bundle on total interest paid over the life of the loan. So if you can afford the higher monthly payment, you'll save yourself a lot of money in the process. You could consider paying for mortgage points. This is a way of reducing your mortgage interest rate by paying an upfront fee at closing. 1 point typically costs about 1% of the total loan amount and can reduce your interest rate by a certain percentage. This strategy can save you a lot of money by reducing your monthly payment and overall the amount of interest you pay over the life of the loan. Let's run an example. Let's say you take a $300,000 loan at an interest rate of 6.87%. That would give you a monthly mortgage payment of $1,976. And over the life of the loan, you would pay about $411,000 in interest. Instead, let's say you buy 2 points that each reduce your interest rate by 0.25% for a total reduction of 0.5%. This might cost you $6,000 up front, but your new interest rate would be 6.37%. Your new monthly payment would then be $1,872 a month, and the total interest paid over a 30-year loan would be about $374,000. That $6,000 up front reduces your interest payment by about $37,000. You have a net gain or a net savings of about $31,000. The other thing to remember is that you can shop around and compare offers. You don't have to just walk into one lender and ask what is the best rate that you qualify for. Ask multiple lenders for what their best rates are, but just make sure to do this at roughly the same time, say within the same week or so, because when they all check your credit score and perform this hard hit, they see your credit score at its peak. If you spread it out too long, the subsequent lenders might actually see a lower credit score because previous lenders have already checked it. It's also important to keep in mind that while rates may seem high today, that doesn't mean they're going to be high forever. Sometimes we get stuck in this mindset of what is going on today is what is going to be the case forever. You can take out a loan today with the intent of refinancing down the road. On a 15 or a 30-year mortgage, if rates drop significantly, there can be a great benefit to refinancing. But keep in mind that refinancing isn't free, and it is several thousands of dollars. So if you notice that rates have dropped, it's worth doing a cost-benefit analysis to see if refinancing would save you money in the long term. The next biggest debt category is student loans, and the high burden of student loans has definitely captured national attention, especially in the past few years. A good general rule of thumb when trying to figure out how much student loans you should be taking out is to not take out more debt than you anticipate making in your first year's income in your profession. Now, it's a good general rule of thumb, but it may not apply to all professions. For instance, if you have a profession where the income scales quickly, like think a doctor or a lawyer, but it is a good general guideline. You can also reduce the amount of loans you would need to take out by going to community college first, or working part-time, or during the summers, or, and I think this is the biggest, most helpful one, getting clear on what you actually want to do and asking yourself if that profession actually needs a degree. If the answer is yes, that's one thing. But I think the prevailing thought, at least in recent history, has been that you need a degree no matter what career you want to pursue. And I think this has ended up pushing so many people down the college path without any sort of direction. And they ended up pursuing degrees that maybe they didn't even want or didn't even end up using. The best practice is to have a plan for what career you actually want to pursue and ask yourself, does this career actually require a degree? If the answer is yes, go get that degree. I think education is incredibly valuable. You just want to be smart about how you go about it. Auto loans are incredibly steep, and it's very typical to see car payments around $500 or $700 a month these days. And more people are spreading out the term length of the auto loans they get these days. In fact, the most common auto loan term length is 72 months or 6 years. Vehicle loans are deeply tied to your credit score, so you want to make sure that you have a credit score that is in tip-top shape by the time you're applying for a loan, if you need a loan to buy a car. Also, follow the general car buying rule of 20, 4, and 10, meaning you put 20% down, you take a loan for no more than 4 years, and you make sure that loan is no more than 10% of your pay. In many cases, I do look at a vehicle as a necessity because for many of us, we need a vehicle to get to and from work. And without that, we wouldn't be able to earn a paycheck. But that doesn't mean you have to splurge on an expensive vehicle. You can have a modest used car. I don't think there's anything wrong with taking out an auto loan if you need one. Just make sure it's one that fits within your budget. But if you can buy a car without a loan, that's even better. No loan really is the best loan. Credit card debt is a huge topic for consumers right now. Consumers have a record level of credit card debt coming in at over $1 trillion. And most credit cards have variable interest rates, which tend to follow the Fed's benchmark. As the Fed started increasing interest rates, APR on credit cards increased following suit. And being that the Fed has signaled to us that they don't have any near-term plans or immediate plans to make cuts, it's safe to assume that these APRs on credit cards are going to remain elevated for some time. The best practice when it comes to credit cards is to only use them to buy what you can actually afford and making sure that you're paying off your balance in full and on time every single month, never paying a dime in interest. If you currently do carry any credit card debt, exploring a zero balance transfer is a really good option, but the whole focus should be to pay off this debt as quickly as possible. And if you are the type of person who tends to fall into this cycle of credit card debt, that shows that you're the type of person who should not be using a credit card. There's no shame in that. Know your blind spots so you can sidestep them. And I look at personal loans as kind of being in this same category. People take out personal loans for all sorts of reasons, like maybe doing a home remodel. But rather than taking out debt in this category, I think it's best just to save up your money and pay for these things outright. When it comes to credit card loans and personal loans, I don't think it's worth paying interest in these categories. Yes, you can make an argument for an auto loan or for student loans in the right circumstances, but I still think that those should be kept minimal. Same thing with a mortgage. Taking out a mortgage allows you to capitalize on the benefits of home ownership, but you still want to make sure that you're only buying a home that you can truly afford. From the stance of how debt propels our economy forward, enhances our GDP, and boosts company profits, and consequently the stock market, I understand why society screams that debt is awesome. From a personal stance, I like the idea of keeping the debt burden as low as possible. Protect your personal financial house. I like the mantra of less debt or no debt is actually pretty awesome. What are your thoughts? Share them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.